Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today, the mayor, the governor of the great state of Texas, Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing pretty good. Hoping I'm not about to get impeached like Paxton is right now. So,
The Attorney General of the great state of Texas is under House rules of not doing the right things. And so we're watching that all play out in the Texas Senate. Just the crazy times in politics in Texas, but you got to love what's going on. We are just towards the end of the summer, Michael. I mean, how are things going in your neck of the woods?
Yeah, it's going okay. You know, it's a little choppy environment out there. We're working through, had a couple refinances, some sales, and we're about to close on our fourth acquisition at the end of this month. And so I think we're doing better than most. Is kind of muddling through the choppy environment that we're in. I think a lot of that's due to a few years ago we traded up in quality, maybe a little bit early in the cycle, but I think that's being rewarded now. So we're just kind of getting through, trying to take advantage of some buying opportunities we're starting to see out in the marketplace, and I think we'll see some more. And I guess we'll see what our guests think about that statement here shortly.
Absolutely. So we're going to talk a little bit about the choppiness of the market itself and some things to be aware of when you're out looking to maybe invest in multifamily. But don't forget, go to the Old Capital Conference, October 4th and 5th here in the great state of Texas in North Texas, up in the Dallas-Fort Worth area. We have the Old Capital Conference. It's the 7th annual Old Capital Conference. You want to go to oldcapitalconference.com and you want to be a participant of that. We're going to have one of our great speakers that's on this podcast today. He's going to be speaking, so we'll learn a ton of information from today, but he'll go in a little bit more detail about what's going on with the market in front of a large 500-person audience at the Frontiers of Flight Museum. Michael, again, why do people want to go to this conference? Yeah,
like I mentioned before, it's one of the only conferences we get a lot of people that are actually out in the business doing deals from both the principal side as well as on the broker side. Pretty much all the shops in North Texas will have some level of representation there, and some from the other markets as well. So if you want to actually go out and meet people doing deals, selling deals, it's a place to go. It's not just a bunch of people trying to sell you tax protest services and things like that you get at a lot of these other conferences out there.
Yeah, it's going to be a fun conference. It's a 2-day conference, and we have probably the best and the brightest of all the North Texas investors, general partners, limited partners, and the vendors, whether it's tax challenges or attorneys that do PPMs or insurance companies that have the insight about where insurance is going to go. I mean, we have two things that are the most expensive line items. It's property taxes and insurance when you buy an apartment building. So we have the experts going to be talking a little bit about that too. So in the podcast today, we have our friends, the crew from probably the most busy group in North Texas that sells large apartment buildings. We have two friends, Nick Flewellen and Wes Rock. Guys, how are you?
Great. Thanks for having us.
So Nick is going to be
Appreciate it, Paul.
On stage coming up here October 4th and 5th. You'll have a chance to spend some time with him and kind of pick his brain about what's going on with the market. But I'm going to turn this over to Michael and let him ask the 20 questions.
Yeah. Maybe, Nick, I know we've had you on the podcast several times, so maybe start with you, give a little background on yourself and your company, and then Wes can kind of clean it up at the end. But who are you guys and what do you guys do?
Yeah. Well, again, thanks for having me on again. And we love this podcast and certainly love the Old Capital Conference as well. And couldn't agree more with what you said about it. It is definitely the place where people should be if they're wanting to talk about deals and wanting to really get a feel for what's going on in the market. So definitely something I look forward to every year. My name is Nick Flewellen. I am an apartment broker based in Dallas, but we have a team of 23 folks, and we're doing deals literally all over this region, East Texas, Central Texas, West Texas, South Texas and all the surrounding states. And so I have been in the business since 2004. And over that time, have been fortunate to build a great team. And obviously, this is, as you alluded to earlier, Mike, this is a challenging time in the market. But, when you're working with great people and you're working hard, I think we're optimistic about where things are headed. And I'm sure we'll talk, more about what we're seeing and kind of what the crystal ball says over the coming, minutes here on the podcast. But that's our kind of bread and butter is B and C class in this entire region. And we do some A class as well in some of the secondary and tertiary markets and outlying areas of DFW.
Yep. And Wes, maybe a little quick bio on yourself as well.
Yeah. So I've been on Nick and Bard's team for about 4 years now, joined in 2019. Nick and Bard have, as Nick said, 23 people on the team. My assignment is very detailed. I focus on the 80s and 90s space in DFW, the larger assets, stuff that you've owned, you've transacted over the years. So my scope on the team is a lot more narrow, but it seems to be in very high demand still, even with interest rates on the rise through COVID. That 80s and 90s space has just seemed to be very resilient. So look forward to talking about that and, sharing some of my insights that I'm seeing real time in DFW.
Well, good. Well, maybe we'll start there. I don't know who wants to take it, but just kind of what's kind of your general take on the market? We've seen quite a bit of rise in the interest rates, and that's become a little bit more difficult to get. So what's kind of state of the market right now?
I was just going to share on Brookside since we had the call for offers on that, kind of what I saw on that. So Paul, I sent it over to you. What's interesting is that we've had our CA count pre-COVID during post-COVID was 300 plus.
And what's a CA
and then
count? What does CA mean?
Confidential agreement. So in order to look at the financials, the offering memorandum, rent roll, all the material due diligence items that you're going to make a decision off of, you need access to that. And us as brokers, we have a direct responsibility to keep that information confidential. So in order for you to access it, you need to go to our website, need to go to the deal room, war room, whatever you want to call it, to have access to those documents. We need to keep that sensitive information secret, not just from the general public, but also the taxing authorities. We don't want them finding out where things are trading. It's a little game in Texas we have to play. So seeing that first level metric is very important to us as brokers, because a lot of people will just rule a property out, a listing out automatically without digging into the deal room if it doesn't fit their size, the whisper, just some basic level information. So having a high CA count gives us a good indication of who's interested, who's looking at this. And having 300 plus confidentiality agreements gives us a good hope that, there's a lot of eyeballs looking at this deal. And then the confidentiality agreements boil down into tours then boil into offers. Brookside, what we just had call for offers on last week, we ended up doing 20 plus tours on the property. I think Nick and Chris Pearson have a deal in Wiley, much smaller deal on the market. I don't know if the call for offers has been announced, Nick, but I think they already beat our tour count, which is really interesting because that's in Wiley. But, it is DFW. It is a core part of the Metroplex, but it's not in Arlington. It's not in Irving. And they're getting the same level of traction on that smaller deal, which is, I think, 77 or 76 units. So there's definitely interest.
So with that CA count, how does that compare to, say, 2021 on a typical deal?
So 2021, it was probably in the high 200 or low 200s. There just wasn't that much engagement because everything was changing so fast. People were pencils down. I remember people were just taking 6 to 9 months off because they couldn't make sense of the market. So the engagement wasn't there. So to see it back over 300, you say 50% engagement, that's a huge increase to pre-pandemic levels of where we're at today. Now, yes, interest rates are the biggest change in that, offer count, but in the end, the engagement is still there where it was previously.
And then, Nick, have you noticed is the buyer profile different than 2-3 years ago, or is it similar, or how's that kind of evolved over the last few years?
Yeah, well, I and I think going back to that, so just one thing to add to the previous question is I try to frequently remind everyone how often in the last 7 to 10 years I've heard people say, well, I'm just waiting for a market adjustment and I'm going to dive in when we get that market adjustment. And I'm not sure exactly what everyone thought the market adjustment catalyst would be if it wasn't going to be interest rates. But, if they thought there was going to be a dramatic decrease in price, but they could still put, 3% rates on their deal. I don't know. That was probably a miscalculation, but I do think we're having an adjustment right now. And I do think there are people that are being opportunistic. Who the buyer pool is today. Well, I first of all, I agree with Wes's point that there are a lot of people looking. I think a lot of the same people are looking. I think some of the same people that are real confident in their equity are still out buying and still getting deals done. I think there's some naivety right now with regard to, maybe some people that have bought deals in the past and think it's the same world on an equity raise side. And I've heard over and over and over again, hey, what was a real easy 2 or 3 day raise on a $5 to $7 to $10 million equity slug is much more difficult now. And I think people are surprised by that, which makes our job of vetting these buyers more difficult because, I've never not closed a deal. I've never had any problem. I've done this so many times in the past. That all just doesn't mean that much right now because I've seen over and over in the last, 18 months, people fall short, especially on the equity side. So I think you have some of the same players. I think you have a lot of new players. I think we have 1031 buyers that are kind of back and in vogue when it's their own money. You can at least take the equity side out of the equation as far as having to go out and raise it. That is, a feather in their cap if they're pursuing a deal. I think that's probably the short answer. You could get into a lot more detail about how some of these deals are getting done and all that, but I think it's a mix of some new with some of the usual suspects as well.
So let's talk a little bit about equity, because that's really been the challenging piece in today's market. Just like you said, Nick, it wasn't that big of a challenge back 2 years ago, where folks were able to throw out a flag and the equity dollars ran to that flag. Today, we are very concerned if you are a seller of having the ability to close on these deals, because some of these deals are in distress. They need to get them closed, and it's really picking the right buyer. So my question really is to you guys is that how difficult is it to judge where, they were successful 2 years ago and now they want to try to buy it today? What are you looking for? What's your judgment? What's your gut saying about what are you asking for people to confirm that they have the ability to raise the equity and get these deals done?
Yeah, well, I don't think there's a clear-cut confirmation. It's incredibly challenging right now. And I mean, the thing I still feel best about is what's going to keep someone motivated when they're struggling with the equity or going to cause them to say, hey, I got to go bring in another partner, or yeah, this isn't going to be as lucrative for me, but I'm going to make this happen. And that's still hard money. I mean, that's, of course, in this environment, people are less likely to want to go hard. They're worried about the debt. They're worried about the equity. They're worried about everything. And they're worried about it moving around. Even if you could accept the debt for what it is on any given day, the way the market's moved over the last 12 months, that may be totally different in 30 days, or 45 days or 60 days. So I think, that is, it's this weird spot we're in where sellers are trying to be flexible and cooperative and letting these folks maybe have longer equity raises, which then shoots them in the foot because interest rates go up and then their proceeds get cut and their interest rates are higher and then they need a price reduction. So thank you so much, Mr. Seller, for giving me more time. You need to take a lesser price, right? So I will say over a lot of years, almost 20 years, I've had only, before these last, call it 12 to 18 months, only 3 deals ever that had 6 figures hard not close. And 2 of them were on the same deal, which was just a coincidence. I've got 2 today that have got multiple hundreds of thousands hard that I think are very shaky. And I think there's at least a 50-50 chance that they don't close just because of equity.
Mike, how about you? I mean, you just closed or you're buying a couple deals. I mean, did you go hard on these deals? And because still think the market right now requires hard dollars to be put into these deals.
I think generally I agree with that. I mean, it depends on the particular situation. We're buying nicer deals and competitive situations, and maybe it's not quite as hard, or as the level is a little bit lower than it was a few years ago, but to get a high quality deal awarded in a competitive situation, I think it still requires hard money. And I think what I was going to ask, and I think you guys will concur, I think the reason the CA count and the interest level is high is because the inventory level is dramatically lower than it has been the last many years, right? So you're probably talking maybe 1/3 of the inventory today compared to a few years ago. So we're like 2/3 off of kind of normal listings. Would that be somewhere in the ballpark, Nick or Wes, you would say is out there right now?
I would say it's previously up to maybe summer. I would say that's 100% true. But it feels like right now there's a good amount of product on the market today. Now, how much more is going to come? I don't know if those guys are trying to get out and beat the storm. But I agree with you 100% before summer. That was a comment we would hear routinely is, wow, you guys have a lot of stuff on the market. No, there's not that much out there. But I do feel like groups are bringing out more product today. And so there is that interest, that spike in interest again. The one thing I would say is, you're offering hard money, buyers are offering hard money. I just had a phone call with a seller on Monday. He said, Wes, this is on a different deal. He's like, we're going to have to take $1.5 million less. And I said, why? He's like, this group has a significant amount of non-refundable. The other group, yes, I'd be making $1.5 million, but I can't go back into another contract where there's not going to feel a pinch. I need to do right by my investors, and we need to get out of the deal. And so if that means us taking less, I have to make that decision, because I think that's the right decision to make right now, is moving on to another asset.
Yeah, well, and I just say that the reality is, if you don't have hard money, you're going to retrade right now. I mean, statistically, that's pretty much happened on every deal that doesn't have hard money. And heck, it's happening on a lot of deals that do have hard money. And the sellers are still taking it, just in light of what's happening in the overall market. Not in every scenario, but in a lot of these situations. So, yeah, I mean, $1 million higher without hard money means very, very little to most sellers right now, because it just sounds like, well, I'm going to kind of get in there and I'll feel out my equity and I'll feel out the debt. It just doesn't convey confidence. And honestly, that's what we need more than anything right now, is somebody that's like, hey, I know it's hard. I really, really like this deal, and I will figure out how to get over the hump with these variables, right? I'm going to lock down the debt, and yeah, the rate's higher than I would have liked, but it is what it is, and I'm prepared for that, and I'm ready for that. And hey, here's my plan of action for the equity, and I'm so confident in both of those things that I'm willing to do this. And if you're not willing to do that, then yeah, I mean, in my mind, it's I'm not feeling real confident that it's going to close.
So I know we haven't had a lot of transactions. You guys, I know, Wes, you sold a deal a week or so ago as we record this, but like from the peak of pricing, which would be Q1 of 2022, that's the absolute peak, to where we kind of are now. What kind of value declination have we seen? Is it in the workforce housing? Are we quarter off, a third off? Like, we're from the absolute peak, are we on pricing roughly?
A third in some situations, in some scenarios.
And so maybe break that down. So you got a 60s deal in South Dallas that might have a chiller versus an 80s deal in Garland. Those are probably two different answers, right?
Yeah.
Significantly.
I think the lower quality of the asset, the higher number that is. It's more challenging to sell C deals right now if the buyer doesn't feel like they're getting a great basis or a great deal on it. And especially if they're larger, because if they're larger, it's a more expensive, or it's a larger just equity raise, and so there just needs to be something really compelling about the deal. It needs to be a really attractive cap rate, a really strong financial trend, an assumable loan, etc. So I think on the nicer quality assets, you're 20-25%, and on lesser quality assets, it's more.
So, and then the cap rate's probably 6, high 5s on the nicer stuff, and probably high 6s and lesser stuff.
I still, my default as of today, early September 2023, I would say a really nice Class A deal. I still think you could, again, depends on a lot of variables and factors, but I still think if you're in the high fours, maybe low fives on a really nice, clean deal. I think when you get into the 80 stuff, again, assuming you're buying it on a cap rate basis and not on a just because you think it's a great basis for the asset, which we have a lot of deals that are trading just because people intuitively know they're buying the real estate for a low price per pound and expect that to go up when the market comes back. But assuming it's a stabilized deal on a cap rate basis that you're trying to put an agency loan on, I think that's mid fives. And I'm talking like 80s product, mid fives. That's if something that's in a pretty good location. I think C stuff is 6+. And we used to say 6+ tax adjusted or 5+ tax adjusted. Now it's tax and insurance adjusted. So to Paul's point about the conference and what the two largest line items are, everybody is spooked on the insurance side as well right now. So everybody is saying, hey, what's the cap rate when adjusted for taxes and insurance? So that's a new a new calculation that we're having to take into account that we never did before.
Yeah. So what we previous times we've had you on, we've talked about how the cap rates when I started 10+ years ago buying apartments was 5 cap for an A deal, 6 to 6.5 for a B deal, and it was like 8 to 8.5 cap for a C deal, and then they all got on top of each other kind of within probably a 50 to 75 basis point band where the nice stuff and the old stuff were trading for the same. And we talked about workforce housing as it was all monolithic thing. It's all the same, where whether it was a 60s deal in South Dallas with a chiller, an 80s deal in Plano, they all kind of had a same cap rate, and the market didn't really price in the risk of the two. And it seemed that didn't make sense to me, and that's why we traded up. And now it seems like the market is pricing in that risk, the insurance risk, delinquency, the bad debt that comes with some of these older deals, and the lower income levels that the tenant base have, and the less savings they have, the more susceptible to little blips in the economy and inflation and things like that. So it seems like that's all have been priced in to some extent, and probably still getting priced in a little bit, particularly on the inferior quality assets. Is that still kind of, we're still seeing price discovery because there hasn't been that many 60 deals trade, really, right?
Yeah, I think that is still going on for sure. And I 100% agree with that. It was like there was no difference. And I mean, you've said it many, many times. There just wasn't big delta and cap rates for all the different, asset classes. And there definitely is now. I mean, you definitely have a 100 basis point or more delta between A and C right now, which we have not seen in a long time. So what's funny though, is even with that delta, it's still harder to sell the C deals, even though there is clearly more value there right now, in terms of just cap rate and ability to potentially have going in cash flow. I still think, there's some opportunity there. So again, there's a little discovery there, and the larger deals, it's just, it's yes, the math works, but you still got to go out and put the capital stack together. And so I think even though people understand that and agree that may be the case, I think, Wes made the comment earlier about our deal that we have in Wiley right now. And first of all, the Wiley's is a great area. Maybe it's not, and there's not that much out there, and it may not be on everybody's radar, but independent of the area, it's a good, clean, quality deal that's a small equity raise. It's an 80s deal that's a very manageable equity raise. And that is why everybody wants to go out and look at it, in my opinion. Yeah. And honestly, we will probably end up with 40+ tours out there, which is more than we've had even in our peak days. That would be an elite tour count on a deal, even when the market was on fire. So a combination of the quality, the size, the lack of inventory, obviously the location, et cetera.
Yeah, it's the size of the deal. So it's a triangle theory, is that these more expensive properties out there. So just like the one we just talked about at the beginning, the property in Arlington is a $30-40 million property. Even though it's a nicer asset, let's say, of size and location of the asset, but it's a larger capital raise than the $10-11 million property out in Wiley, which is a 70 some unit property. That I absolutely love that deal. We did the loan originally for the guy who bought that transaction, say 11 years ago, and he's maintained it for a long period of time. But it is a triangle theory. There's more buyers at the lower end than there are at the higher end. So that absolutely makes sense. So the other question I was having just about leverage point is really negative leverage when it comes to the debt. Because right now we talk about a little bit about cap rates, but fixed rates right now are what, 6.5%. And we're talking about, maybe these C-class properties built in the 70s and 80s, maybe they're going up to say 8%, because if they're at 6.5, where Fannie and Freddie are at with say 10-year fixed rates. If you buy something at that number, you're going to have negative leverage. Mike, what do you think about that?
Yeah, I mean, so it seems like us included, if you buy a deal, you got to have a path to positive leverage year one. So, if you're paying 6% on your debt, you got to, through the combination of driving rents up through renovations or some cost containment or whatever your model is, you got to get to the point where you're neutral to positive leverage pretty quickly, or the math's just not going to make a lot of sense. So I would imagine that's probably the case that people are looking at, Paul, and I'm sure the guys probably would concur with that. Is that kind of what you guys are seeing for like year one cap, where people are trying to get to positive leverage?
For the 60s and 70s space, it's almost cap rate and interest rate have to be together, or even cap rates higher. People can't afford to take a risk to go in with a negative cap rate versus interest rate, and they need to see that cash on cash day one. I think if you transition all the way to the A space, what you were saying, Mike, was they need to see a path to positive leverage for the A space. But in C's or 60s and 70s, they can't afford to have that just because of the risks of plumbing, chiller, flat roof, all those surprises. They're like, hey, I'm not, this isn't the time for me to be risky. I need to know that the cash flow is going to be there. 80s and 90s is kind of in between. What's the deal story? Where were properties trading before? Is it positive leverage, or is it, am I breaking even day one? That's kind of where I would say the in-between is right now from where cash flow is. It's more, not necessarily cap rate, but more emphasis on cash flow, especially when you have, 2-year treasuries or 5-year treasuries that are risk-free at 5%. That's a hard argument to beat for, older product. Is why would I invest when I know I can make this in my sleep?
Yep. That's a headwind if we raise the money. I think, Paul, too, what's the typical spread right now on an agency loan? What are you kind of seeing over the treasury?
Oh, 1 3/4, 1.8 to 2.5 or so.
So, if you got, I think really what is the biggest kind of headwind where we've seen a little bit more activity to where I think is a little bit of a headwind on the cap rate is that 10-year treasuries, as we record this, kind of been around 4.25 for a month now, so if it's sub 4, I think you see the appetite go up quite a bit more, at least on the nicer end of the scale. If it's above 4, makes this math hard, because then like you said, Paul, you add 2%, 2.5%, the low to mid 6s, unless you buy the rate down, or unless you have a great track record with the agencies and get a little tighter spread, or if there's some sort of mission, meaning some affordability within it, the agencies will get a little bit tighter, and they were a little more aggressive. Especially Fannie Mae had 35-year amortization waivers that they were doing, and then that went away. Come summertime, around June or July, that went away, and so they're being less aggressive, and they're not going to hit their numbers. And I think they're okay with it. So it seems kind of interesting. And then back on the equity, sorry to bounce around a little bit. It seems like to me right now, where if you go back 2-3 years ago, you had in all spaces, but it's like the workforce space, you had both syndication groups where they go past the hat at 50, 100,000 at a time. They're very prevalent. And then you also had these groups that will partner with like JB Equity, get single source equity checks where they would do like a 95-5 kind of equity split, and they would go out and do these larger deals like the ones Wes you were talking about, where they would do that. And where we're kind of fast forward today, it seems like all the JV equity, by and large, or the vast majority of it are pencils down. And so really the environment that the buyers that are out there, your best bet are those that could go syndicate capital, which may not have been the the choice you would have went with, 18, 24 months ago. Have you noticed that too as well? There's just not much JV equity out there.
I would say there's not a lot of institutional equity out right now. They're still silent. And that was one of the catalysts in late 2020, 2021, is it seemed like the institutional equity just flooded the market space, and they couldn't get money fast enough. But a lot of people were indicators still have $2, $3, $5 million of equity that are ready to be placed, either from a 1031 or from a recent transaction. But the institutional money is definitely quiet right now, allowing syndicators to still be engaged.
Yeah. And so Nick, you've been around 20 years now. It's hard to believe that, but what do we see? Like how
It doesn't look like it at all.
I know.
Should have seen me 20 years ago.
How do we see the rest of this year kind of playing out? And then what do we see as we start 2024? What's your crystal ball on kind of activity, listings? What do you see pricing? What do you kind of expect to finish out this year and start next year?
Yeah, no, I think it's a good question. And I would say, first of all, been through a couple cycles and a couple of significant events. And I would say the number one encouragement is that we bounce back better than before. And so how quickly that happens, I don't know, but I tend to be on the side that it's going to happen sooner rather than later. And I would say from a pure activity standpoint, we have done more BOVs this year than last year and the year prior, year to date. And so I'd say that's an encouragement in terms of just potential deal flow coming. Now, the rest of this year, I don't think you're going to see a whole heck of a lot because it's just we're going to be dealing with timing. And if it's hard to raise equity in December, normally it's extra hard right now to raise equity in December. And so I think if you're not seeing deals launched here pretty quick, in the next 30 days, I don't think you're going to see a whole lot more actually formally marketed the rest of this year. I do think we've had this situation where all of these folks that maybe had these floating rate loans have tried to hold off as long as they can, and they were hoping for a pause and hoping for some relief on the cap costs, and they just haven't. It just hasn't happened. I thought it would have happened by now. Hopefully, we will be paused, but I just think every time we've thought something was going to happen, the Fed has had other ideas, and so. At this point, I think you have people that are about at the end of their rope as far as how long they can hold on. I had a call with a group yesterday that is kind of in that boat, and that is I've got a call later on this week with somebody who's like, hey, I don't see this getting a lot better anytime soon. And so I think the conversation that GPs are having with their LPs and people should be having is, would I rather do a capital call? Or would I rather sell for 85 cents on the dollar, 70 cents on the dollar, whatever the number may be? And again, what should that answer be? I don't know. It depends on the asset, depends on a lot of different factors. But I think what we're going to see is a lot of people are going to opt for the sell for the 70 or 80 cents on the dollar and just move on. And I think that's what a lot of the activity is going to be in the early part of next year. And so I am optimistic about Q1 in terms of more transactions taking place. I don't know that it's going to get a lot easier on the debt or equity side right away, but I think people are figuring that out, and they've had a lot of time to kind of ponder how they want to do this. I've also seen, you were talking about JV equity. Yes, JV equity is hard to come by, but what I'm seeing more of is people that have had success on their own, combining forces with other people that have had success on their own and saying, you know what, hey, it's better to do a deal together than to just not do a deal at all. And so I think that's a good, viable strategy to potentially bring more dollars to the table. I had a call yesterday with someone who I thought would be interested in a deal where the existing buyer is having trouble with the equity. And I just said, hey, what do you think about potentially partnering up with these folks and coming in and raising the last little bit? And you could be the GP and controlling partner in the deal, and they've already raised the majority of it. And that was appealing to the person. So I mean, these aren't easy deals to put together, but at this point, we got to be thoughtful and creative with how we're structuring these deals. And if if you're a GP out there, you got to be looking at all different avenues. And doesn't mean it's forever, but it sure is better than the alternative, which is sitting around and doing nothing.
No, I mean,
I'm optimistic.
Yeah, I think that what you said earlier is you've had these conversations over the last however many 7 years where people said, "Oh, I can't pay this price. The price is too high. I'm waiting for an event." And here we have the event, and it's freaking hard to raise capital as a guy that does it for a living. I mean, it's appreciably harder than 18 months ago, and sentiment's pretty terrible. One of the things that we had all benefited, and all four of us in this call, was the velocity of money. These deals trading every 2 years, and you double your money every 2 years, and then the person invests 100,000 in a deal, gets 200,000 out, and then they invest 100,000 in two deals and keep reinvesting, and that money is gone, right? And a lot of these people are already allocated or getting a cash call on this deal or that deal, so the sentiment's a little tougher. And I think that's speaking to, I'd rather raise 5 million than 10 million to do a deal, because it's half the work on a gross check. So these smaller deals are probably holding up pricing a little better. And if you have a 300 to 400 unit 80s deal in Garland, that's probably not holding up as well from a valuation standpoint, because bigger is not better right now where it was a couple of years ago. So, but I do think that, now, or, we've been putting our money where our mouth is. We've been buying some deals. We're still buying the nicer stuff, but I think at some point it's going to make sense to go back in time and buy some of these older deals, because the cap rates differential is real, and you're getting paid a premium on your yield to buy an older deal to take that risk on. So if that's now or some point in the not too distant future, I think that's going to be compelling. And I think the debt will honestly be better on the older stuff, because the agencies want mission rich, and that's what they're going to want. So, whatever the math starts making sense, and rates won't go up forever, feels like that right now, but, it feels like we're kind of at or near the top of the short end of the rates, probably be near peak, I hope. Who knows? But seems like they're kind of slowing down on the hikes. The long end might have a little way to go, and it seems like we're probably at peak property taxes. I think I feel pretty confident in that statement that taxes will be lower next year than they are this year. And I'm not sure about insurance. I might keep going, but we've seen a big move in insurance. So maybe on a percentage basis is not as much. So you're starting to see some of these variables. I think some reliable indicators that we're peaking out on some of the pain, and you got some sellers that need to capitulate. And if you're not going to buy in an environment like this, I don't know what you're waiting for, right? I mean, it seems like 2024 might be the year to go buy a bunch of deals and make a bunch of money and sell them in 27, 28. And
yeah. Well, and it's funny. It's like if you just step back and just drown out the noise for a bit, wouldn't you rather buy a deal at a 6 cap than a 4 cap? It just on the surface, yes. You'd rather buy a deal at a 6 cap, and
that has taken a big tax increase and insurance increase baked in that cap rate too, right?
For sure, 100%. So, and some people ask me, they're like, who are going to be the winners? You go back in every cycle and you say, hey, who are the winners? Who came out of this? And you're like, golly, I wish I'd have done what they did. 100%. There's not a doubt in my mind. The people that are getting deals done right now are going to be the winners when this is all said and done, because there are great deals to be had right now. Now, are they great deals in the short term with the debt that you have to put on them and the cash flow? No, they're not like jumping off the page, right? I mean, yes, I could have bought a deal at a 4 cap and put a 3.5% fixed rate or a floating rate loan on it that was interest only, and gone in and done my plan, and that worked out really well, and that was all great. And so I get it. I mean, I've been invested in a lot of those deals. So I believe me, I have sold a lot of those deals. I get it. But I will say that, on the surface, when this debt recalibrates and when rates start coming back the other way, I think people are going to be real excited about some of these deals that they have been able to pick up at numbers that would have seemed impossible 2 years ago. Because I think we're not that far removed from a time when we thought every 80s deal is going to be 200 a door, and the blink of an eye. I mean, that's where it was going. There were some sales that were in that range. Now there's A deals that you can buy for less than that, and there's 80s deals that you could buy in the low hundreds a door again. And so I'm very convicted and confident that I think people are forgetting where they really make their money on these deals is A, when they buy it, and B, when they sell it, that pop on the back end. And if you fast forwarded 5 years, 3 years even, I think that pop is going to be considerable at some of these bases, some of the bases that people are able to get these deals at today. So it doesn't make it any easier to magically get equity to appear. And, even as I think about myself and really all of us, we've all been LPs in deals. Yeah, my LP dollars are not flowing as much as they were flowing last year and then the previous years. So I get it. I mean, we're exhibit A of people that aren't investing as much as they normally would, but at the same time, the deals that I am investing in, I'm real confident about and feel really good about. And I don't care if I'm not getting a ton of cash flow right now. And I don't care if I could put it into treasuries and get 4% or 5% at just my bank sitting there, because I don't want 5% over 5 years. I want 100% over 5 years or more. And I think that's what we're going to see. I think there are going to be a lot of 2, 3, 4x deals, and people are going to look really smart, but it's just hard
difficult
for people
in the short run.
It is. It's hard for people to believe that, or just to part with those dollars right now, just in light of the overall state of the economy. I would say the last thing I would mention is I feel really, really fortunate to be in Texas, and really fortunate to be in DFW specifically, because this market is strong, and this market has a very attractive job force, and is growing, and will continue to grow. And as I look around the rest of the country, and even what my colleagues are doing in some of these markets, it's like, whoo, as rough as we feel like it is here, I mean, it is night and day better than the vast majority of the country. And I mean, I'd struggle to name a city that I would feel. Yeah, I'd struggle to name it, literally a city. Yeah, that you'd feel any better about than Dallas.
And then Los Angeles passed rent control again for another segment of the county. So it's just, that's why DFW doesn't ever catch a break. It feels like it's always competitive, no matter what scenario, no matter what happens, DFW catches a break. Whether it's hurricanes, insurance, or rent control legislation, like Nick was saying, our colleagues, they have to deal with that. Where we have a state that just passed a bill, it's getting some opposition, but we just passed a bill that mandated the 3-day notice to vacate for non-paying tenants. I don't know what other states are doing that kind of help to landlords versus pushing it the other way, trying to get it extended for tenants. So we're continuing to stay strong, especially in DFW, like Nick was mentioning.
Well, if you want to meet guys like Wes Rock and Nick Llewellyn, come to the Old Capitol Conference coming up on October 4th and 5th in the Dallas-Fort Worth area. Go to oldcapitalconference.com. We just announced that our keynote speaker is a gentleman named Chris Cassidy. Chris not only went to the Naval Academy, he was a Navy SEAL, and then, this is something interesting, spent almost a full year in space, over a year in space. Did 3 missions, one in the space shuttle to the International Space Station. Believe me, we talk about the challenges. Imagine being up in space, away from your family, and all the things that could kill you pretty damn quickly. He's going to talk a little bit about some of the challenges that he faced. And, we always tried to bring in somebody that's kind of an extraordinary person. And we thought this guy was the one that you want to listen to, kind of telling his story, our story for the country about what we're doing up in space. So come to the Old Capitol Conference and meet guys like Nick Llewellyn and Wes Rock that will give you the insight about what's going on. Last thing I'm going to talk a little bit about before we say goodbye to everybody is really, I think we talked a little bit about timing of the market, of what's going on. I will say, in my opinion, I'm starting to see some of the people that have been on the sidelines for the last 3 or 4 years. I mean, I'm talking about good operators that have been around for 20 or 25 years, that for the last 5, 6 years, they couldn't understand the market, so they weren't investing in the market. My conversations with some of these, I think they're pretty smart real estate guys, that they're starting to back the truck up. They're starting to see the opportunity that just about to pop and come into the multifamily space that they haven't seen in 6 or 7 years. And these are, I think, are the smart investors. And those are the guys that Nick and Wes are talking to every day, that they're coming into the market. So if the smart people are coming in, maybe you should think about doing it too. So we certainly do appreciate Wes and Nick. Again, Nick, do me a favor. How do people get a hold of your group? What's the best way?
Yeah, I think the easiest way to kind of see who our team is and what areas they cover would just be to go to our website, which is multifamilyadvisors.com. Again, that's multifamilyadvisors.com. And that's got all of our contact info, our inventory, some great research, etc. So we'd love to chat with anyone who would love to know more about some of these opportunities we were talking about.
Sounds great. Wes, Rock, Nick Flowen with Marcus and Millichap, Michael Becker with SPI. We certainly do appreciate you spending some time with us. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.